As usual, prices taken directly from the IPO candle provide significant long-term ranges to reference. In this case, it is a strong range of support. Here is a great example of a double top that begins to slow down after the initial break. The 135.50 to 117 range was the site of a failed Head & Shoulders from October to November 2007. It later marks the neckline and shoulder level of a larger successful Head & Shoulders, with the double top as the head. A minor upswing is reversed by another double top in April. This time it is in the context of continuing the larger downtrend. This event is also in line with some stable descending trend lines that form somewhat of a channel in the short to medium term. On closer examination, the declined double top is part of a relatively compact Head & Shoulders. It is another case where double and triple tops share characteristics with the Head & Shoulders pattern. The minor variations in height of the downswing points are of less importance, since attention for all these bearish patterns looks towards the lower boundary, that is around 108 in this case. Trend lines are useful when there is a major uptrend off the IPO range later on. Descending trend lines could have also been drawn from the first double top and Head & Shoulders, but they would have been shorter-term guides as they were on steeper angles. A minor gap fill prior to the horizontal range of a bullish continuation that clears back to newer highs. In the continuous climb to new highs, the market directs short-term attention to the current small gap up and bearish engulfing that have not immediately led to a drop. Short-term stance goes from bullish to neutral with resistance from the 520s. The gap is decisively filled, and moderate support pauses the drop while bearish sentiment increases. This also begins a double top's completion. Naturally, this would have already taken place after closing under 500. But in this case, the gap up in combination with the double top forms a wider lower boundary. In the event the gap up fill range centering around 480 is breached, the chances of larger drops become more likely. 500 to 480 is a major range that goes back to a gap up from several years ago, adding to the significant potential for an accelerated drop. If the 480 area is conclusively breached, bearish consistency gradually pushes under the gap fill range, but the large drops don't materialize due to the relatively weak break, as seen with lowering bearish volume ending August. The minor September upswing will now direct attention to see if strong resistance will remain at the 480 to 500 boundary to continue the developing downtrend in the medium term. Market activity is low and slow due to indecision from early September, but a gradual neutral to increasingly bearish stance begins to emerge. The current stronger close lower accelerates the delayed declined double top reversal. A pair of gap up ranges provides excellent reference for support as the downtrend progresses at a moderate pace. 390 is not contacted as the descending trend line is surpassed. To show another example of a trend line from a double top being a useful guideline in determining the progress of a recovery. The late October upswing did make good progress in recovering from the double top. However, strong resistance remains at the 480 to 500 range, where another potential double top has just formed. It is close to a strict double top reversal, though it may have been difficult to spot if there was too much fixation on the short-term volatility, seen from mid-November to December. The previous descending trend lines retain influence during the current development of an upswing off the aforementioned 390 area. A classic passive but steep rise after strong overselling ends at a major support area. As seen with candle analysis, the new uptrend is strong with consistent but not exceedingly high bullish price action and volume. That is why it is more of a passive rise. It is a strong recovery due in large part to the absence of selling volume rather than a series of large bullish spikes at the end of December. There is no long wait as the minor drop onto 525.50 is quickly overcome to gap up and place the first double top far behind. Naturally, a gap fill and the pair of double tops provide a major landmark for long-term support that was especially useful during the turbulent start to 2020.